afternoon. Good afternoon, everyone. Give me a few minutes. Let me get set up and we should be ready to roll. In the meantime, I'm going to put some soft music for you. Give me a few minutes until we start. Come on in. Give me a few minutes before we start. Let me just set everything up. Give us a few more minutes. I'll be starting soon. Fifteen more seconds and we will be starting. Thank you, those of you who are already in. Okay. Welcome to another wonderful Winning Wednesday. It's always a pleasure to be here towards the end of the day to spend some time with you. And thank you to all of you who are here with us today. I see one or two familiar names. Thank you so much for being here. We always appreciate you taking out your time in your tight schedules, or you could be doing many other things. So thank you for being here and choosing to be here with us. I appreciate that. We thank you for that, and we hope that today's session will be as beneficial to you as it was to us, as it always been to us. So thank you for coming in. Thank you for spending the time. We will be starting shortly. Lee is still held up. I'm hoping he'll be able to come in. If not, you are in safe hands. I'm always happy to be here. I'm always happy to do these solos as well. So you are welcome. One of the things that I know Lee loves to share about before we start the session is something to do with the economy or where we are. And I read an article earlier on that was talking about real estate. And as many of you may know, I am licensed in real estate here in Virginia and I practice around Northern Virginia. So I like to read all these news, particularly real estate news, to just see where the markets are at, what's happening outside of Northern Virginia, as well as within Northern Virginia, just to make sure that I'm up to date with what's happening around me. And one of the things that I was reading earlier on was about, and if you know, a lot of investors, real estate investors, love doing buy a principle called buy, renovate, rent, um, refi, and repeat. We call it the BRRRR strategy. And I, for one, do that as well for my business. That's one of the things that I do in order to continue building wealth for my family. That's a strategy that we do. And this article was talking about how that strategy is pretty much non existent of late. And I had to sit down and think through it to really determine where we are at. And one of the things, yes, that are pretty, should I say, out there is that mortgage interest rates are pretty high right now. Whether you believe that they're pretty high or not, everything is subjective. However, a lot of these strategies count on hard money, and hard money tends to have higher interest rates. So you're talking, pretty much. I don't know if I've seen anything in the nines. I know I've seen interest rates in the 10%, 10 to 12% for hard money. So, what this article was really talking about is that right now, when you try and employ that BRRRR strategy, the biggest challenge is that when you have such high interest rates, it becomes very difficult to buy that property, renovate it, rent it out, and then try and refi. Because the whole purpose of you refinancing is that you want to be able to pull out that money that you put in, or as much money as you can, so that you can use that money to go and repeat the process. However, with the way interest rates have been so high and with the amount of homes that are on the market that prices have also gone up, it becomes a little bit more difficult to get into these properties, be able to do what you need to do, refinance them, and get as much money out to go into the next project. That's something to think about. Hey, Lee, happy to see you here.
Happy to be here.
Yeah, so I was basically just talking about one of the articles that I was reading. You probably may want to chime in on this one. And it was basically referencing how the BRRRR strategy has been a little
How
bit
many R's
difficult.
did you use there, baby?
I know your tongue just gets rolling into the RRR.
You stop at four R's. I think you might have touched on the fifth one.
It's for BRRRR.
Yes.
Yes. So it was really talking about how in Northern Virginia right now, that strategy has been pretty tough for most investors. Part of it being that with the high interest rates, even if you get into a property and try and if you get into a property and try and refinance, a lot of times you are not able to pull out as much money to be able to go and repeat the process into another property. So if I've put in 100,000 to get into this property, do what needs to be done, I would want to pull out whether it's slightly more or slightly close as possible as to what I've put in so that I can use those funds to go into another property. However, if you're going to put in, let's say 80, 90,000, and you can only pull out 20,000, that means that it's going to be extremely hard for you to get into another deal using the same funds unless you have another source of capital that you can use to get into another opportunity. So I don't know what you have been seeing in the market or if you have anything to add on to that. Of course, this is not just based off of just the interest rates, there's also the element of prices being so high that even when you rent out, it's difficult to rent out at what, the 1% rule. What have you been
Yeah.
seeing?
Well, we actually just spoke about this last night,
Mm-hmm.
right? And when the 1% rule doesn't pass muster, and the 1% rule probably goes up to about 200 to 300,000, right? So if I buy a house for uh 300,000, right? The 1% rule says that I have to charge $3,000 for rent,
Mm-hmm.
right? And I don't know too many homes in the Northern Virginia area that you can rent a townhouse, which is a $500,000 house, for $5,000 a month. It would have to be extremely high end, etc., in order for you to be able to garner that amount of rent. And it would probably have to be furnished, and also it would have to come with a number of amenities in order
Yeah.
to be able to capture that price point. So when the 1% rule fails, the conversation has to transition over to how would I be able to get to that 1%, right?
Mm-hmm.
Same exact property, but how can I get to that 1% rule? And one of the things that we spoke about was co living last night at the Cash Flow Breakfast Club.
Mm-hmm.
And the concept of co living is, rather than renting out the entire house to one tenant, you can get more if you rent out the rooms of the house. So one of the things that I learned, this is not a strategy that we have explored extensively, but one of the things that we explored is, now you buy a house that's like, let's say, a 5 bedroom, 4 bathroom house, right? And you try to put 8 people into that house. Now you're going to have to do certain things to that house in order to be able to accommodate that, because you're trying to do, uh everyone should have a private bathroom. If they don't have a private bathroom, you have to establish something called house rules in order
Mm-hmm.
to do something like that. Like, for instance, if you're not in this space, you would never know that with a co-living type of situation, you shouldn't put a TV in the living room,
Hmm.
right?
Yeah. Yeah.
Because if you put a TV in the living room, that's going to invite people to want to come there and sit. And, you've been watching basketball games with me. I tend to yell when my team is not winning. Good thing we live in a house by ourselves. Maybe our neighbors might be able to hear me screaming. I don't know. But you could
They
imagine
probably
if we
do.
were renting out the room, I would have to be in my room yelling. That's something that I learned when the BRR strategy doesn't work. You have to pivot to a co living type of model. However, there are certain restrictions at
Mm.
the county level. There are definitely going to be restrictions at the HOA level to prevent you from doing those types of things, right? Because when it comes to co living, right, what do you do about parking?
Yeah. Yeah.
You have a house that was supposed to be set up for one family. However, now you have 8 adults living there. So there's probably going to be at least 6 cars, at least 5 cars that are going to be there.
Mm-hmm.
So how do you handle that particular situation with that. So typically what we heard last night was that you you um you purchase these kinds of houses that are not in HOAs. And what I learned is that the legislation, because in Loudoun County, Virginia, there is legislation that says you cannot have three non-related people living in one dwelling.
Hmm.
And that was put up, I think, in the ninja days when people were just, buying houses and stuffing as many people as they could into that
Okay.
house. That legislation came out from that. I know that that's something that is available, that is legislation in Fairfax County, and I know that it touches on to Loudoun County just the same,
Yeah.
right?
Well, but I think me mentioning this was really also just to bring to light that when you have a strategy, right? A lot of times the expectation is that your strategy is gonna pull through. It's gonna go all the way, right? However, sometimes your strategy may not, depending on so many other things, whether it's economic climate or whether it's, just availability of homes in your area that you're buying at, many other things may affect that strategy. Then what happens is, as an investor or as a business person, what do? You have to always be in a position where you're able to pivot and you're able to say, okay, plan A isn't working out. What else do I need to do here? And I
Hmm.
wanted to use that to dump into, well, to get into what I also wanted to talk about today, because as we continue building our businesses, one of the things that we had to learn is that you are not able to execute what you don't know. And this refers to the entire business credit. When we got into business, we we knew of business, we knew what we wanted to do, we
Yes.
knew how to do what we needed to do. However, we did not know about business credit. What we
Hmm.
knew about business credit, now we know that was pretty much nothing, because what we knew is we needed to have a separate bank account and we needed to have either credit cards under the business. But that credit card under the business was not fully explored to really understand what it means when we say this credit card here is for the business or is under the business, whether just the name was sufficient or there was more to it. So, one
No,
of the,
to be
Mhm.
honest with you, we had a credit card that actually had our name on it along with the business's name
Yeah.
on it,
Hmm.
right? And we were under the impression at that point in time that we were working on building out our corporate credit profile,
Yes.
right?
Hmm.
But what happened is we were using some app, and every month it would tell us what was going on with our credit score. And your credit score is basically determined by your debt to income ratio. So on a monthly basis, it's going to fluctuate just a little bit. But pulled the annual credit report, and then I looked and I saw that this credit card was still showing up on my personal credit profile. And I was like, oh, this is not what I thought what was happening.
Yeah.
But you had equated pretty elegantly the fact that we thought that we were doing what needed to be done at that point in time. And we created the entity.
Hmm.
We went to the IRS and we got an EIN number.
Yep.
We went down to the bank. We opened up the credit account, well, the bank account, and we put a significant amount of money into that account, owner's equity, right?
Yeah.
And we thought we were cooking with gas. The thing that we
Mm-hmm.
didn't know that we now know is that we had to go and get a Paydex number. And we started that about 2 years after having gotten through all of this. So we applied for Dun and Bradstreet. We realized that, hey, they still send the Dunn's number via snail mail. We waited for it to come in. Then we learned about the Paydex score and what is the Paydex score. And we learned how to manage the Paydex score, but we didn't know that, oh, there's another score with Experian commercial called the Intella score, right?
Mm-hmm.
And as we were on our journey to building out corporate credit, we then learned that many of the vendors who we were doing business with weren't reporting to the credit agencies at the same time,
Yeah. Yeah.
right? And I don't say that to say, oh, how silly we were, because we did the homework. We bought the books, we read the books cover to cover, and we learned what we thought was needed at that time, and we took action, right?
Mm-hmm.
However, we still didn't know everything that we needed to know, but I believe those lessons are where we can actually help our customer
Yeah.
to navigate that journey and not have to end up where we were at the same time. I think
Exactly.
I
Exactly.
think I think
And
that's it.
and this is why I wanted us to have this conversation, because I think a lot of times when we have conversations with business owners, a lot of people believe that because they have a business current account and they have a credit card in the business name, they believe that they have started building that business credit. Or sometimes we've had people who say, oh, I have a net 30 with company X. That means I've got good business credit. I'm building my credit.
Hmm.
And it's not necessarily always true. Like we've said, we had to learn that not every vendor that you have some type of an account with does actually report to the bureaus. And part of this conversation really is centered around the importance of making sure that as you are on your journey as a business owner, you reach out and explore from others to make sure that you are doing the right things for your business. If you're looking to grow your business, if you're looking for funding for your business and you don't want to continuously be personally guaranteeing every little money that you get, then you have to jump on building your business credit and doing it the right way and making sure that when you say you are building your business profile, you actually have the concrete evidence of that. You can pull out a report that shows you what your paydex score is, where you are, how much debt you have on the business versus what you have on you personally. So, those are things that I think a lot of business owners may not necessarily be aware of. And it's one of those things that for me, I feel it's very important for us to make sure that we do share the process of how all this works and the understanding that, yes, if you do not have the knowledge of how it all works, you may believe that you are doing it right when in fact you are just not doing it 100% how it should be done.
And nothing is wrong with that,
Yeah.
right?
Mm-hmm.
Nothing is
Mm-hmm.
wrong with that. But I do say learn how to do it the correct way as
Exactly.
fast as possible so that you don't waste time, right? Because time is the only commodity that I'm aware of that cannot be recycled.
Yes. Yes.
And number two is this is your business, right? Where you are putting in your blood, your sweat, and your tears,
Mm-hmm.
right? And all businesses, I don't care what business you are in, they will have highs, they will have lows, and then they will have highs again.
Mm.
And even if you don't need the money today, having access to a credit facility that you can tap into is of value for those times where it goes low, it was unexpected, and you still have to make payments, you still have expenses that need to be cured, and you can tap into that line of credit. And when things get back better again, then you can just pay off those facilities and have them available to you when you
Mm-hmm.
need them. You don't want to be in a situation where you have to take a drastic type of action that's going to jeopardize you, that's going to jeopardize your company, that's going to jeopardize your family at the exact same time. So I think we're doing a lot of preparation for the unknown unknowns, right?
Yeah.
Things just happen,
Yeah.
right? And being prepared for that so that you can make your business survivable to those unknown unknowns.
Well, the reality of it is that as long as you are a business owner, there will always be things that come up. There will always be great moments. There will always be moments where you say to yourself, man, how do I get out of this one? Right. So, the last thing you want as a business owner is when you are going through something to then at that point say, let me now start building my business credit. You want to build it before anything comes up where you're going to need those resources. So just being able to have places where you can tap in and get the assistance that you need as soon as possible, that could be the determining factor of whether your business makes it or not. So you want to make sure that you continuously are learning, you are continuously equipping your business with the right resources to make sure that you are sound, financially sound, and that you are prepared. You can never be over prepared, I believe.
Mm,
You have to always be prepared because you just don't know what's going to come tomorrow. But when you are prepared, it makes that load a little bit easier to carry when you know, okay, I need to write a check for this amount of money. Where am I going to get that? Oh, I do have a line of credit. Maybe it's time that I tap into it, right? But
no,
anyway, yeah, go ahead. Sorry.
no, I was just gonna say you have to have access to a line of credit.
Yeah.
And one of the things that we also are big advocates of is not only having access to a line of credit, but also having access to cash value life insurance policies, which can be used as a line of credit,
Hmm.
right? During those ebbs and flows. So, two things that, if you take away two things from today, is one, if you're a business owner, make sure that you have insurance for the unknown unknowns. And to supplement those unknown unknowns, make sure that you have access to credit facilities that you can tap into, right? For those unknown unknowns. At that point in time, you have mitigated the risk to your business for those unknown unknowns.
That's true. That's true. Well, thank you, Mr. Lee. Thank you for that. I think we always appreciate the wisdom. It's very important to be able to share experiences and transfer knowledge. That's how, as businesses and as a community of business owners, we can grow by helping each other out, just to make sure that our lessons learned don't become the downfall of someone else that could have used those lessons learned equally and be in a position where they're able to mitigate some of those misfortunes that may or that could happen. But thank you. I think we are slightly over today, but thank you all for sticking with us. Thank you for being here. We always appreciate your time here. And for those of you who are in businesses and are looking to come on this platform, to come and share a little bit about what you do, talk about your business, what got you here, lessons learned in your business, and what you're looking forward to in the next couple of, whether it's until the end of the year or until beginning of next year. There's a QR code on my left hand side corner at the top. Scan that through. We want to connect with you. We love interacting with other businesses. We want to know what you do so that we can share. And who knows, we might be able to collaborate. So scan that code and reach out to us. Let us see if we can get you to come on the platform to come and have those conversations. Other than that, Lee, any closing words?
No, thank you for sharing your time with us. We understand that time is the most important commodity,
Mm-hmm.
and we say thank you for sharing your time with us today.
Thank you
See
and
you
have a
next
good
week.
one. See you next week on another wonderful Winning Wednesday.
It sounds better when you say
Oh, if you say so.
it.